two investors put the same money into nearly identical funds for 30 years. One walks away with hundreds of thousands of dollars more than the other. The only real difference? They picked different fund wrappers. Let me show you how. ETFs and mutual funds are the two most popular ways to invest in a basket of stocks at once. They sound almost identical and often hold the same things, but a few quiet differences can cost you a fortune. Start with what they share, because it's the most important part. An ETF and a mutual fund are both just a big basket that holds many investments, like hundreds of different stocks, all bundled into one. This gives you instant diversification. Instead of betting on one company, your single purchase spreads your money across the whole basket. If one company sinks, the others hold you up. That's the magic of a fund. Both can track an index, like the S&P 500, handing you a tiny slice of America's biggest companies in one click. So at their core, they're doing the very same job. The differences live in the details. Difference number 1, how they trade. An ETF, an exchange-traded fund, trades like a stock. You can buy and sell at any moment the market's open, and you watch its price move live, second by second. A mutual fund works differently. No matter when you place your order during the day, it only actually trades once after the market closes, at that day's single end-of-day price. You're not watching a live number. For a long-term investor, this honestly doesn't matter much. You're not day trading your retirement. But the ETF's flexibility and live pricing is why so many newer investors prefer the way they feel to use. Difference number 2, the cost just to get started. Many mutual funds carry a minimum investment, sometimes $1,000, $3,000 or more, before they'll even let you in the door. That stops a lot of beginners. With most ETFs, the minimum is simply the price of one share, which might be $50 or $100. And with fractional shares now common, you can often start an ETF with literally $5. The door is wide open. Difference number 3, and this one's the big one, fees. Every fund charges a yearly fee called the expense ratio, a small percentage of your money taken each year to run the fund. It sounds tiny, but it adds up brutally. On average, ETFs that track an index tend to carry rock-bottom expense ratios, sometimes as low as 0.03%. Many older, actively managed mutual funds charge 1% or more. That gap is massive over time. Why should 1% scare you? On a growing portfolio over 30 years, that seemingly small fee difference can quietly eat hundreds of thousands of dollars of your future wealth. Fees are a silent wealth killer. Now an important clarification, because it confuses everyone. The real battle isn't just ETF versus mutual fund, it's active versus passive. And that distinction matters far more than the wrapper itself. An active fund has a manager picking stocks, trying to beat the market. You pay high fees for that effort. A passive fund just copies an index, like the S&P 500, and charges almost nothing to do it. Now the part decades of data keep proving. Over long periods, the large majority of expensive active managers fail to beat a simple, cheap index fund. You pay more, and you usually get less. That's the trap. There's one more sneaky difference: taxes in a regular taxable account. Because of how they're built, ETFs are usually more tax efficient. They tend to trigger fewer surprise tax bills than comparable mutual funds do. Mutual funds can hit you with something called a capital gains distribution, a tax bill you owe even if you never sold a single share. ETFs are structured to largely dodge this annoying surprise. Inside a retirement account, though, it doesn't matter. So which one should you actually choose? For most beginners today, a low-cost index ETF is the simple, powerful default. Low fees, a tiny minimum, tax efficiency, and instant diversification. It's hard to beat that combination. But don't dismiss mutual funds entirely. A low-cost index mutual fund can be just as good, and they shine inside workplace retirement plans like a 401k, where they're often the main option you're given. The real lesson is this: don't obsess over the wrapper. Obsess over two things instead. Is it a low-cost fund, and is it broadly diversified? Get those two right, and you're already ahead of most investors. Now let's put this to work. Step 1, open a brokerage account or use your existing retirement plan. Step 2, look for a broad index fund, like a total stock market or S&P 500 fund. Step 3, check the expense ratio and make sure it's rock bottom, ideally well under 0.2%. Step 4, buy it, automate a regular contribution, and then let time and compounding do the heavy lifting. That's genuinely it. You don't need to pick winning stocks. You don't need to time the market. You just need to own a cheap, broad basket of companies and keep feeding it consistently, year after year. Let me steer you clear of a few traps. Mistake 1, picking a fund based on last year's hot returns. Past performance doesn't predict the future, and yesterday's winner is often tomorrow's disappointment. Chase low fees, not hype. Mistake 2. Ignoring the expense ratio because it looks like a tiny number. Remember the termites. That little percentage compounds against you for decades. Always check the fee before you buy anything. It's the one thing you control. Mistake 3. Overcomplicating it. You don't need 10 different funds that all own the same companies. 1 or 2 broad, cheap index funds can cover almost everything. Simplicity isn't just easier, it usually performs better too. Mistake 4. Panic selling when the market drops. The whole point of a broad index fund is to ride out the dips and capture the long-term climb. The investors who sell in fear are the ones who lock in real losses. Quick rundown of what we covered. ETFs and mutual funds are both baskets of investments. ETFs trade live like stocks with tiny minimums. Mutual funds trade once a day and often need a bigger amount to start. The thing that matters most is fees and diversification, not the wrapper. Favor low-cost, broad index funds. Avoid expensive active managers who usually lose to the index, and mind taxes in a regular brokerage account. Master this one decision, and you've unlocked the foundation of nearly every wealthy investor strategy. It's not flashy, it's not complicated, but cheap, boring, diversified index. Investing is how ordinary people quietly build real fortunes. If this finally cleared up ETFs versus mutual funds, give it a like, follow the channel for more plain English money breakdowns, and send it to a friend who's just getting started. What should we explain next? Tell me below.